Good morning or good afternoon or good evening, depending on which time zone you're in. It's Eric Coffin. I'm here in Vancouver with my friends Joe Mazumdar, who's also in Vancouver, and Brent Cook, who is in a bunker under a mountain someplace, because that's how he rolls. We're going to do a couple of short presentations. I'm gonna flip it over to Joe here in a minute, but I think the bulk of this is going to be Q&A. I do have some questions that some of you have sent in that came in through email. I've got those here. You can ask questions. You should have a panel on the right side that allows you to type questions into the chat. I will be monitoring that. I mean, obviously, we won't be able to answer everybody's questions. And keep in mind that, although the three of us collectively keep track of a lot of things, it's not like we watch every single company and every single market. So if something comes through and it's just a company we don't know anything about, we're probably not going to bother answering it. We'll deal with maybe two or three of the bigger geopolitical questions and try to answer some company questions. I'm going to pass this over to Joe. Now Joe's going to run through a short presentation, and then I will as well. And then after that, I'll open this to questions. So I'm just going to pass this over to Joe. Okay, Joe.
I got it. All right. Okay, so as usual, my presentation might be longer than I want it to be. But basically, this will be just a presentation in terms of what we're seeing in the market right now and how we're reacting to it. So that way, that hopefully answers some of your questions. And so I'll get to it right now. We'll talk about pre-COVID-19, what we were thinking, COVID-19, the reaction by the countries and the economies, and the impacts on commodities, and focus on the mining sector and the risks and opportunities. So pre-COVID, we were bullish on precious metals, and one of the underlying was the amount of negative yielding debt. Gold has no yield, but if everything's negative, gold looks good. The other idea was the global emissions, reduction of that. And so really what we were focused in was nickel, copper, palladium, these kinds of metals. And this is just a presentation or a slide from Norilsk about tightening emission standards and the impacts on these different metals. And so definitely in copper, my idea was a development project that would fit in this 2023-2025 window in terms of deficits. And that's our exposure to a project like Trilogy Metals, who have a joint venture with Cell 32, and that's how we're playing that. And with respect to nickel, the way the battery technology is changing, such that we get more nickel now in each battery, the way we're playing that is with an ASX listed company called Blackstone Minerals in Vietnam, who just recently did a private placement with a Korean cathode and battery manufacturer at a 60% premium. The other one was palladium, and that deficits continue, and actually palladium prices this year have continued to be supported by this. And the way we're playing that is with Platinum Group Metals in South Africa, we're waiting for a pending option being triggered by Impala on that one, and a construction permit. Okay, COVID-19. Okay, we know what happened. So around PDAC is when we started feeling the impacts of COVID-19, and the focus definitely was on China, but that was important enough because China's impact on commodities. And as you could see, the difference between 2003 when SARS happened and 2018 was the size of China's economy, going from 1.6 trillion to 13.6. But as importantly is its impact on the global market. Travelers to the US, for example, went from about 160,000 to over 2.8 million. And so their reach is much bigger than it was during the SARS epidemic. And so now we're sitting at, now the COVID-19's everywhere. And the one we're worried about, the market's worried about the most, is the US. And so the whole idea here is the reaction of the countries. Each one is dealing with its own curve, is just basically trying to flatten this such that its own healthcare system can actually maintain, reduce its fatalities. And so everyone's right now without a vaccine. The mitigating factors are rudimentary, basically physical distancing. In Florida, keep about an alligator between you and the person next to you. Soap and water over hand sanitizers, and now the introduction of masks. And so everybody's got their own curve. Some of them dealt with them pretty good, like South Korea. Taiwan has been exceptional, and we could look at China coming off their plateau and now coming back into economic production. But right now, the big worry is the U.S. up here, and when will this one plateau? And so right now, the forecast by big banks like JP Morgan are that over the next 2 years, because this impact from COVID-19 isn't a monthly thing, before there's a vaccine, this could be at least a year. But again, the normal won't be what it was pre-COVID. And so the losses potentially to 2021 could be about the size of Japan's GDP, about $5 trillion. And so you could see the impacts on industrial production in China pre-COVID-19 in January 19, before they started reacting to it, January 19th, sorry. And then basically this is the nitrogen dioxide levels through China, and you could see the big reduction. And now just in early March, it's picking up. People begin to return to work. So the reaction to COVID-19, so if you look at the CNN Fear and Greed Index, like just a month ago before early March, it was well into greed at about 60, and it fell like down to about 4 on March 10th. And the idea is that, are we going to go through a recession? And it seems like a recession is probably the most likely scenario. But, we're talking about 2 consecutive quarters of falling GDP, depressed industrial production, unemployment going up, income reduction, fall in retail sales. The bigger worry, a lower probability, is does this keep going longer, where unemployment hits 25%, prices fall, we have deflation by more than 10%. The poster child, there's a Great Depression that lasted about 10 years in the 30s. And so what we have seen is, unemployment. This is US unemployment, like spectacular, unprecedented, over 10 million in 2 weeks. And how the US is playing this is the federal rate, as the US interest rates are plunging down to 0 right now because of the COVID-19 impact. And so also we see expanding balance sheets. And so the balance sheet right now is about, during the 2008 global financial crisis was sitting at about 2 trillion. Now it's gone up to about 4.6 trillion. And underlying that, you can see the market's reaction to expanding balance sheet on the right. The S&P 500 did quite well in expanding balance sheets, but this time it has done less well because there's an underlying fear that this monetary policy means that the situation's much worse than they thought it would be. And you can see on the left gold's reaction to an expanding balance sheet, which is mixed. When it was expanding initially after the global financial crisis, gold hit its peak around 1900 plus, but after that, it'd been following. And so the commodity impacts, and so this is year-to-date numbers are the gray bars, and the blue bars are weekly. So, but you just look at the gray bars, the biggest impact has been the increase in market volatility. Basically, right now, the VIX as a proxy for market volatility is the highest it's ever been, much higher than it was in 2008 during the global financial crisis. You're seeing bond yields depress as the demand for 10 years goes up. Oil's having its own issues, not just with demand, but also with overproduction in a demand-light environment. But most of the commodities have been down, except for palladium and gold, and recently uranium. So the big issue has been the industrial production reductions, fall in activity, driving down base metal prices. And that's been having a big impact on copper, lead, nickel, and zinc. So, but the uncertainty so far has been supporting gold prices. And so as you could see, the VIX up here, got up to about 83, and it didn't get beyond about 40 in its last peak. And during the global financial crisis, it was around 50 when gold was spiking up to about 1900. Right now, gold's at about 1700, but during a time where VIX has peaked to 83, and if you look at that little inset of the American Eagle 1 ounce coin that the US Mint sells, that's priced at about $2,175, whereas the spot price is much less. And so the another encouraging part about gold prices is it's up in multiple currencies. So last year it was up about 18% in 2019 by average on these different currencies. In 2020, it's up about 16%. But in terms of looking for companies and looking for miners and plays, I mean, you could see that South Africa, that currency has been weakened. And so the local commodity prices in South Africa would be, pretty good. In Australia, they've been going really well. I think it's around $2,500 locally. So if you're looking exposure to gold price, you can get even more leverage by picking the ones with the weaker currencies. And Australia, Canada, and South Africa, because they're big resource economies, have been more impacted by weaker currencies because of the reduction in industrial production in China. Okay, and if you want to compare gold price in 08 to 2020, you could see the volatility in both 2008, which is the gray line, and the dashed black line, which is currently. So gold has gone down to 1480, but spiked back up right now to almost 1700 again. And in 2008, gold basically peaked at 1,000 during that year and fell about 30% down to about 700. And so if you look at silver, which we were hoping might have a better reaction in this precious metal market, I mean, I thought 90 was high for the gold to silver ratio, but obviously it went up to about almost 130 right now. And so we're hoping for that one to bounce back. And if we look at the equities that we invest in terms of the gold sector, this is the GDXJ versus the market as a whole, the S&P 500, it's been just as volatile. You can see that the GDXJ has been up to 45 earlier pre-PDAC and fell down to 22. And you can see the market as well with its big fall. Okay, so mining sector related, I mean, if you want to invest, which stage? And so right now, because of the mining disruptions, usually when you look at precious metals and you're looking for leverage as the gold price goes up, you want to first look at the producers. But now with the COVID-19 disruptions, that might not be the best way to play it right now in the near term, because probably Q2 production will look light as everybody has withdrawn guidance. Another way to play it is in some base metals, and that you can see that there's a window where there's just not enough production, and those projects have to come in now because otherwise they're not going to fall in from somewhere else. And so those ones that are not spending money on construction, doing the light work, looking for financing, those are the ones that I'm mostly invested in, that are well-funded to permit, well-funded to advance, but not in peak construction. And also on the exploration side, that's another play that we continually look at. And it's multi-commodity, it's very commodity agnostic. It's just about discovery. And so you can see the issue on disruptions. According to the S&P Market Intelligence, we've had about 300 operations impacted. I graphed basically on the right hand the different commodities from iron ore to PGMs on the right, the number of operations impact, and the production at risk versus the 2020 production estimate. And the big ones have been platinum, palladium because of South Africa, silver right now because of Mexico and Peru, uranium right now because of Kazakhstan, and copper throughout the world, like especially the Americas. Chile, Peru are seeing lockdowns there. Okay, so this is a specific example of Pan American taking a hit, and my sort of crude or estimate at the potential impact in operating cash flow that could be about 20 million from a loss in production of 7 to 8%, using my assumptions on a month of production loss and a 10% reduction in Canada. So, but we have seen M&A. So we saw Endeavour Mining bidding on all share for Semifo. We saw Premier with an unknown partner making a bid for 50% of the Hard Rock Gold Project in Northern Ontario. We've seen people financing with mixed results. Orla Mining raised 75 million in a bought deal for a Mexican gold project, whereas Silvercrest had trouble closing theirs. Like I said, Blackstone, the nickel project in Vietnam that we have shares in, raised money at a 60% premium with a strategic investor. So that's really the play right now, is the industry people that know in the medium to long term the paucity of projects out there that are now pulling the trigger on investing. Japan Gold signs a strategic alliance with Barrick for the majority of their projects in Japan. Impala right now is sitting on the fence with respect to its option to acquire 50% of Waterberg, which is a big underground PGM project in South Africa. And interestingly, with Sandstorm, even though they've withdrawn production guidance, they're well financed and have a significant line of credit. And so what they're seeing is the potential to pick up precious metals streams on base metal assets, which is the perfect sort of streaming formula if you can get it. And right now there might be more opportunities on that side. And so the opportunities that we took action on were plays like Mag Silver. So our idea was to pick up quality plays that have fallen like the market, but we know the underlying assets high quality. So we would pick up something like Mag Silver, picked it up at $6, sold it over 12 for a quick double. Liberty Gold. Again, this is well-funded discovery style exploration. Southern Idaho, managed to get it at about 60 cents. I continue to hold this one because they are actively drilling. They're funded for 2 years, and we got news flow coming out over the next year because they haven't stopped drilling. Okay, and that's it for me. So I will hopefully be able to do this. Share, pause. Okay, and I go back to sharing and then change presenter. Eric, yes. Okay, Eric. Whew.
Okay, I just unmuted myself so you can. I just unmuted myself. You'll be able to hear me now. I muted while you were presenting. I'm just going to
nice.
Flip over to my slides. And I'm going to back to the start. Close this off. I'm going to I'm just going to go through some very top-down stuff very quickly here because I was kind of viewing this thing as being more of a mainly a Q&A session. Obviously, today we got a little more action from the Fed. They came out with yet another big swinging bazooka, 2.4 trillion this time. I thought it was interesting what they focused on today because it's something that I've been pretty concerned about. I actually talked about this pretty extensively in the last issue of the Journal that went out, and that's that they really had to do something to try to underwrite the high yield and junk end of the debt markets because they were looking very, very sketchy up until a couple of days ago. I was happy to see that probably more money than that actually went into loan facilities aimed at small business and municipalities. That is a smart move and I think really important because the only way to minimize really significant long-term damage from this virus pandemic is you've got to get money directly into the hands of municipalities that do a lot of local spending, small businesses and individuals. Yeah, as usual, like 2008, 2009, these first couple of bills have had their share of crony capitalism in them, with a bunch of large organizations getting bailed out, but really that's not where the problem is. The only way you're going to minimize impacts is you've got to get it directly to people. I mean, obviously, it's not a coincidence, I don't think, that this came out today, since the U.S. announced another 6.6 million in initial jobless claims. 3-week total is now 16.8 million. If you were to translate that into an unemployment rate, which it won't actually show up in those numbers for a month or two, but that implies a current unemployment rate, or current as of last week when these numbers were put together, 15%. It's probably 20 now. Hopefully this is simply a short-term unemployment rate, but some of these jobs are going to be lost for good, I suspect. Fed balance sheet, of course, we're probably up to, I had a recent one that went up to about 5.5 trillion. Obviously, a lot of this money isn't spent yet, but as it is, and this includes multiple special purpose vehicles that are being used to underpin multiple different markets, you're probably going to see the Fed balance sheet hit 10 trillion, quite possibly by the end of this quarter. Obviously, there's no precedent for any of this stuff. We're in uncharted territory, literally and figuratively, when it comes to all of this. I did consider it today a positive sign, not because it bounced the gold price in the equity markets a bit. I think it was a positive sign because I think if the Fed and Washington, but really the Fed probably even more than the politicians, if they learned anything from the great financial crisis 12 years ago, it's that they didn't move fast enough. There were things that they should have done quicker. They probably would have had a much shallower decline in the economy had they gotten onto some of this stuff faster. Clearly, the FOMC learned that lesson because they've been trying very hard to be proactive and get in front of this stuff. I think that's a positive. Yes, I realize it creates a nightmare in terms of a Fed balance sheet that somehow, some way has to get paid off down the road. But if I was in their shoes, I'd be doing the same thing, namely worrying about that later. This is basically charts of two ETFs. The one on the right is the high yield corporate bond ETF, and that's essentially the B, double B, triple Bs. Basically the level that's right above junk. The one on the right is the junk index. As you can see, those both took a big hit. You have to keep in mind when you're looking at these are price indexes, so they should be moving in reverse of yields. So as yields drop, the prices should go up. The fact that these got hit this hard during the last month, when the whole yield curve was basically shifting down 1% to 1.5%, that's incredibly ugly. That tells you how much money was coming out of these markets. The circle areas, of course, is today's reaction. So for now, at least, what the FOMC did today seems to have worked. There's obviously a lot of money that's flowed into those two markets. I'm not sure whether some of those buyers are going to regret it or not longer term. I suspect some of them will. It's really going to come down to how long and how much money is the Fed willing to throw at this. Are they willing to keep increasing the size of these credit lines and these special purpose vehicles? And just if you're not aware of how the Fed works, the reason why most of these are special purpose vehicles is, strictly speaking, it's not legal for the Fed to buy most of this stuff. Their charter doesn't actually allow them to go into these markets. That's the reason why they're setting up these special purpose vehicles. And the Treasury borrows money from the Fed and puts it into these special purpose vehicles. That way the Fed's kind of one step away and isn't buying them directly, because under the Fed legislation, they're not actually allowed to do most of what they're doing right now. But again, correctly, I think they decided they couldn't wait, that they had to get on it right away. To give you something a little closer to home that I'm sure has most of us a little bit more cheered today, this is current as of about an hour ago, GDX and the GDXJ. As you can see, the more senior companies so far, at least, notwithstanding the production issues that Joe mentioned earlier, and I would agree that is going to be a valuation issue, because of course it's not an equal thing. Some companies are a lot more affected than others. It simply depends on what the lockdown, how strong the lockdown regulations are in a given jurisdiction. Presumably the larger companies that are spread across a bunch of jurisdictions are getting a little bit more love. You can see the GDX at the level an hour ago anyway of just under 29. It managed to get back through its 50 and 200 day average, and it's not really that far off the the high from earlier this month. GDXJ hasn't come back as much, but it has gotten above a couple of pretty important technical levels. I'm quite positive on both of these and gold stocks in general. I do think it's important to remember all of these ETFs and the stocks for that matter. Stocks are stocks after all, and when you're in a liquidity seeking situation, which is where we've been for the last month and a half, I break these sort of bear markets, if you will, into two major classifications. The early part of them is always what I call liquidity seeking. That's the just get me the hell out of here phase. People are basically selling everything. And the simple truth is the easier it is to sell, the more it's going to get sold. That's one of the reasons why gold gets sold so hard early in March. Not just because people didn't like gold, it's because it's what they could sell. When you're in the liquidity phase, you sell what you can sell, not what you want to sell, because you're simply trying to maximize cash holdings and get your leverage down as fast as you can. We, in my opinion, haven't yet entered what I call the insolvency phase. That, in fact, is what the Fed's trying to forestall. That's why they're setting up all of these facilities to buy all of this debt and to try to channel money as fast as they can to municipalities and individuals, because the longer grinding part of a recession / Great Recession / depression, hopefully it's the first, not the second or the third, is this insolvency phase where businesses hang on as long as they can. They run out of cash flow, they run out of cash, they shut their doors, they don't reopen. That phase takes several months. If you think back to the great financial crisis, we had a drop, then we had a bounce. The initial drop came around and just before the Lehman bankruptcy in late 2008. That's actually sort of where it bottomed, was right after the Lehman bankruptcy. We had this quick dive. It then ground back up, had about a 20% rally. We're sort of at the same place now in this one. And then after that, you saw this grinding decline again, and the ultimate low was about a 50%, 55% in that case drawdown, whereas the initial bounce was like a 20, 25%. It's very similar this time around, and I expect a similar outcome, unless they find some way to reverse the impact, psychological and economic, very quickly. I expect we see a similar drawdown in the major markets this time, 45, 50%, but that's not going to happen in 2 weeks. It's going to happen over several months. But the good news for us is one of the winners, and that's probably going to be gold stocks. I just wanted to throw this chart up here because there was a lot of well-founded consternation a couple of weeks back. People were wondering why GDX and GDXJ weren't reacting better. Part of the problem with ETFs is that you aren't buying the underlying stocks. You're buying essentially a private label fund that's designed to try to emulate those stocks. And the people running the fund are trying to trade it day in and day out to match the underlying portfolio. It's actually difficult to do that in practice. And the more volatility there is, the harder it is. That's why ETFs are so dangerous. I'm not a huge fan of them. I tend to prefer, it's just the way I roll, I tend to prefer individual stocks. But I agree that things like GDX and GDXJ are decent proxies, and they're easy to trade. I'm putting this one up here, and this is the JNUG, which is the triple leverage bullish ETF on gold stocks. And I'm putting this up as a object lesson, because you take a look at this thing and it just basically got obliterated. It got destroyed in the last month. And keep in mind, this is not the triple bearish. This is a triple bullish that should have traded far better than this. Essentially, my advice is most of these leverage ETFs, just stay the hell away from them. You're basically juggling dynamite trying to play these things. And I think, in fact, one of the outcomes of this latest crisis, I will be surprised if you don't see the SEC actually outlawing a lot of the leverage ETFs, because this isn't the only one that's had problems. There's all kinds of them that have blown up in the last 2 or 3 weeks. I think you just plain want to stay away from this stuff. That's pretty much it. The one other thing I want to mention is I've seen a lot of comments that were questions in the ones I've received already about inflation. I mean, obviously the predominant gold bug stance is going to be with Fed blowing up its balance sheet like this, what's coming is this, hyperinflation, Weimar Republic, blah, blah, blah. I'm not expecting anything that dramatic. And I'm not in the short term expecting inflation. There's no way to classify what's going on right now other than a massive supply / deflationary shock. There's no way we're going to see inflation in the near term. We might see inflation in the longer term. This graph that I've got up right now is basically the M2 money supply in the U.S. And this chart is a little bit out of date. They update it about once a week, and it would have gone up substantially again in the last week. So you're probably looking at, this is year-over-year growth. You're probably looking at year-over-year growth now in the, I would say, 15 to 20% range. That is higher than we've seen in a long time. I think that may push some inflation, but that's not going to happen until we come up the other end of this thing. I just do not see short-term inflation with this kind of situation. The one thing that we've got to see, this is a long-term chart of what's called the monetary velocity of M2. This has been the issue for a long time. You can see the velocity of money topped out in the late 90s, about 97, 98, at about 2.2, the ratio. It's now down to about 1.3-ish. It's actually lower than you see on the right side of this. I imagine it's coming up again. You'll notice if you look at the great financial crisis, there was actually a big drop in monetary velocity. The reason why you saw that was because all that money that got created then, most of the Q1, Q2, Q3, it largely went to financial institutions that hoarded it. It largely went to bailout large funds, the crony capital that so many people were angry about at the time. One of the best things that I'm seeing out of this crappy situation we're in is seeing the Fed trying to channel stuff as much as they can to small businesses and individuals. If we're going to actually see inflation in the traditional sense come out of this money supply growth and this Fed balance sheet growth, it's going to be because it gets pushed down to individuals and small businesses who inject it into the economy and don't hoard it. That's what gives you monetary velocity. That's what gives you inflation. So this is something you want to keep an eye on. This again, it gets updated. This is generally a quarterly one, but there's weekly ones that they run as well, series. We want to be seeing this monetary velocity increase. That's when we'll get inflation. That will add on to everything else that I think is basically a plus for gold. With everything that's happening out there, I've said it several times last month, I'm very bullish about gold. I think we see at least $2,000 probably in the next 2 or 3 months. And I'm not a gold bug, but even as somebody who's not a gold bug, a year out, especially if this velocity picks up and inflation starts kicking in, I don't really have a lot of trouble envisaging $2,500 plus gold price, which I can assure you I didn't think I'd be saying a month ago or 2 months ago. But 12, 18 months out, I won't be at all surprised if that's where the gold price is. I think that's probably is where it's going to be. Now that's pretty much all my comments. I've got a bunch of questions here, some of which Brent and Joe have seen, some of which they haven't. But I'm just going to stop showing the screen. Because you don't really need that. Just go back to the three of us. I've got a bunch of questions here. You guys have seen some, not others. I've got more questions coming in. So let me just open the question panel. I'm going to start with maybe a couple of things. Start with something, maybe a couple of things a bit more general. There was a question. You sort of answered this, Joe, but there was a question about Liberty Gold. If you've got any sense of, if you got any feel for a longer term target and or, takeover price, say. I realize the second's probably an impossible question, but what sort of gains do you think are realistic, assuming everything keeps going well for them? You got a feel for that? I don't know how hard a target you want to put on anything.
Yeah, I don't want to put a target on it, but I'm just hoping to make a lot of money on it. The thing about Liberty, the important part of it that would generate a premium would be the volume, the tonnage, potential, exploration upside. It's an oxide heap leach, and one of the only ones that I see out there that I think is exceptional and could actually garner an M&A bid because of its tonnage, its grade, and the metallurgy, which we should see more of that data coming off in the latter part of this year. And so the other positive is that they're well funded. They're well funded, even though they're going to be drilling well over 35,000 meters this year, and they actually can continue to drill, which is important. They'll have catalysts. Is the fact that they've got enough money for about 2 years. So importantly, for any of these non-cash flowing companies, whether they be development, exploration, you need them to have money to ride this COVID-19 until we have the issues sorted out, such that they don't have to return to the markets. And Liberty definitely does not have to. So it's got catalysts, it's got an asset, it's got great people. Moira was involved obviously with Long Canyon and Frontier, so she obviously gets these open pit heap leach deposits. So yeah, I mean, for me, it ticks a lot of boxes.
Yeah, and just
Okay.
come along here. There's a good chance I'll be driving up there to take a visit at the end of the month. It's one of the few places I can go. It's only probably 5 hours from here, so that'll be worthwhile as well, seeing how they're progressing, what it really looks like, what the strip ratio is like, getting down to some details so we can get some sort of sense of tonnage, grade, and economics.
Okay, this one, I'm going to throw this one at both of you guys. This is a general question, just if you've got some thoughts on strategy about when you take profits on these things, assuming and expecting that they move higher. Do you have any kind of rules of thumb that you follow in terms of where what price levels, what sort of gains you decide to take some off the table? I mean, how do you guys approach that with your own trading? Either of you want to step in?
Can I go first?
Yeah.
Right.
Go ahead, Joe.
There's a lot of sense to selling when you get a double, but I don't tend to follow that policy, if you will. To me, it's all about what the data is telling you. If the information coming in keeps getting better and better, I'm more likely to add to a position than sell half and ride the rest, because it's so rare that we come across a true discovery that looks like it's going to turn into a mine. So in terms of something like, we'll go stick with Liberty Gold, provided they continue proving our thesis, that's something we'll hold and maybe add to depending on the results. Joe mentioned Mag Silver. That was a real opportune thing. We saw a stock, we know that stock real well. I've known it for years, decade now. When that would drop from $12 to $6, it was clear there was a fund or someone desperately selling. That was like, this is a great deal to buy right here. And the fact that it doubled in a week or so, it's like, that's just free money. That's not something that we intended to buy and hold for a long time. Well, there's nothing wrong with it. It was just an opportunity. And likewise, I think the biggest mistake a lot of people make that I've learned the hard way as well is when something goes wrong, we tend to get out right then and just take the loss. Holding on to a stock and hoping something nebulous happens that's on the good side generally ends up meaning you lose more money. And that's my take. What's yours, Joe?
Yeah, I mean, the thing is, I don't know if there's hey, I made a double, I want to take some profits, but definitely in this volatile market, I'm definitely looking to book some returns. That way I can have capital to buy other things. So it's not just about, hey, I can make more later, but if I already made a double, and then where is this going to go from here, and can I get more bang for buck in something else that hasn't doubled and put more money into that? And so we have a limited amount of companies we invest in, 2025, And if you hold everything forever, it gives you a limited opportunity to buy something new that comes up. And so if anything, the portfolio is actually expanding a bit because I like what we own, but I still want to make room for some other stuff. And so even though I like Sandstorm, I booked a profit, a double on Sandstorm. I sold a royalty generator in EMX because they did what we wanted them to do. They gave us a decent return, and so we went down and bought another royalty generator that had a fraction of the market cap. And so that's basically how we play it. Like if we sell something, do we have something that we want to buy to fill that gap?
And from your comments earlier, is it fair to say that your short-term at least preference would be royalty as opposed to producers? I mean, how concerned are you about valuation near term because of these shutdowns? I mean, obviously it has an impact, but is this something that you think we have to worry about as a medium-term thing, or is this just a short-term thing?
I don't know, because every country is different, and so we're seeing slowdown. So some places it's just actual lockdowns that went from 2 weeks that'll go to a month in places like Peru. Argentina actually came back up, but its impact on a lot of mining companies a lot less. It does have a big impact on Sandstorm and Yamana with Cerro Moro, but overall not as big an impact obviously as in Chile or Peru. And so as the COVID-19 pandemic moved from China, who consumes the metals, everybody was really worried about, they're not going to be consuming, and so we're going to have a glut of inventory, blah, 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 blah. But now it's moved to the producing nations, and now we're not producing. So it's harder for them to take advantage of the price spikes now that are being driven by the disruptions because almost everybody's disrupted. And so the way that I'm looking at playing that, I still own Pan American Silver, but I'm just not recommending it as a top pick. So with respect to Sandstorm, it is diversified, but I'm looking at it from the perspective of opportunities that they might have that they wouldn't have if it weren't for the COVID-19's impact on base metal producers and their opportunities to help them fund. And they have capital. And so to get those types of streams for me is like, the nirvana for somebody like Sandstorm to get a precious metal stream on a 20 to 30 year mine life base metal producer, like producing now, which is run by a major operator. That would be the goal.
Okay. I got a question for me here that I'll go through quickly because I haven't sent anything out yet because I was in the middle of this and there's all kinds of other shit going on with the Fed and everything today.
Can you say shit?
I can say whatever the hell I want. It'll get worse, don't worry. I got asked about Great Bear's results. I mean, I haven't, like I said, I haven't had a chance to go through them in detail. I got to actually look at the sections individually, but I mean, short answer is I'm happy with them. I mean, they've managed to fill in a couple of fairly decent looking sections in the gap zone. It's not 100% consistent, nor would I expect it to be. Thinking back about 15 years ago, when there was a company in Indonesia that used to put out these really good sets of drill results, and everybody was happy with those because they were so consistent. And I can remember Dave used to be paranoid about it and go, "This isn't what Mother Nature looks like." I'm happy to see the stuff with Great Bear. That is more what Mother Nature looks like. It's not going to be the same the whole way through. It's not going to be I'm not expecting a 5 kilometer long, 500 meter wide pit. Great Bear might be, but the grade comes and goes in a couple of areas, but there's a really large amount of tonnage there. But I got to sit down and get a feel for. They did put out 2 or 3 sections that I think take up about 300 or 400 meters of strike length, all of which actually look quite good. It keeps getting better. I think they're one of those companies that is probably getting some swing. Silvercrest is another one. Both of them were added to GDXJ. And I believe that does generate some swing. It's probably helping them today because GDXJ is actually up 8 or 9%. So I suspect they're getting some added buying because of that, because it's trading quite well. And I've seen a couple of jumps sort of into the trading day that to me might have been people reacting to results. But also I think you might have been seeing some GXJ buying. But short answer is I was pretty happy with results. I got a question here for you two guys. that I thought was an interesting question actually was Centerra's rejection of Premier's Hard Rock offer. Is that a good thing or a bad thing for Premier, presumably? Do you consider that a positive or a negative, or where does it leave things?
So we own Premier. That's been a disappointing one over the last year and a bit because of the issues that they've had. The Mercedes operation in South Arturo is just now ramping up, and Hard Rock's always been sitting there as the primary part of their valuation. The 50-50 joint venture with Centerra funding everything. And I think they had $30 million left to fund to basically get the 50%. And then what had happened was they put out a new resource, and the resource was higher grade, had more near term, and so they wanted to take that resource and put it in an updated feasibility study. And so Centerra decided that, okay, that resource needs work. We don't want to put it in the feasibility study, but what was unusual is that they were issues that they could have dealt with within the agreement to discuss this directly with Premier and delay it and to have a discussion. And instead, they chose not to talk to Premier, went around them and went straight to the courts, effectively delaying the project by a field season. Because this is going to drag out in the courts maybe to October, November, when they first have their first hearing. And so in the interim, for Premier perspective, we don't have a valuation because these guys are delaying it. So from Centerra's analyst point of view, they're valuing their 50% stake in Hard Rock, a multi-million ounce, 1.5 or 1.4 gram open pit in Northern Ontario that's permitted at about 80 to 90 million Canadian, which is whatever, 50 to 60 million US. The offer for 50% of this asset by basically funded by a partner, but we don't know who it is, for 205 gives Premier the ability to put a mark to market on the value of their 50% stake, which they're not getting value for. And so for me, that's the important thing, is to just get an underlying value. And now basically let the negotiations begin. I don't think it's going to be sorted out by the courts. It's going to be sorted out by the companies. And I don't think Centerra, even though they have a significant working capital position, they've got projects that they got to develop. They've got big pre-strips at Kumtor, such that their ability to come up with, $400, $500 million to start development of this project is, questionable at this point. Probably what's underpinning their plan to delay this project, but they probably should have talked to Premier without having to go through the courts. I hope that answers the question.
Okay.
So it's positive is what I'm taking from you, Joe.
Yeah, because Premier gets an underpinning of value. They didn't have one. Everybody was ignoring Hard Rock. And if you don't have a mark to market with an M&A bid, you've got nothing.
Okay. Do either of you have thoughts on? I don't follow it personally. We're obviously all aware of it. Do either of you have thoughts on Kirkland Lake? Any current?
No. We were involved in Fosterville when it was New Market, but I unfortunately sold it when they got bought out. Now, okay. So sorry.
Okay, let me just flip through here. Somebody asked about, Golden Triangle, I guess specifically. Would you be looking at a producer like Perennium or Imperial, or would your preference be something more speculative, like an exploration company? They mentioned Skeena and Dolly Varden, but as a more general question to keep away from some politics, perhaps, or you can feel free to jump into the politics if you want there, Brent. Would you go producer end or explorer end? If you got a preference for which way you'd go?
Joe and I have talked a lot about.
I think you can take this as a general too.
Yeah, no, Joe and I have talked a lot about Pretium in the letter. I've been in, Washington. He's visited. I know it's put out there as a probable takeover target by somebody. I'm dubious, given the inconsistency and erratic nature of the mineralization, and my suspicion that there's been more high grading than we're aware of in the deposit. So Pretium's not one that I'm personally putting my money into. The Golden Triangle itself is a great, massive mineralized district full of all sorts of different types of deposits going on. Skeena is all about metallurgy. I think they're coming to grips with it, but they've got more work to do. And from there, I'll let Joe comment.
Yeah, I mean, like Brent said, Pretium's been around for a while. People have looked at the drilling results. I'm sure they've signed a lot of CAs with majors that, have their own resource estimates. And what we've seen from Pretium is, is a steady reduction in forecast as they try to quantify the variability of the gold. Like, if you use this factor called the coefficient of variation, it was basically the standard deviation of all the results over the average. That sits at well over 20, which is ridiculous for a gold deposit. A highly volatile variable might be 5, 3. 27, yeah, that's a bit high. So for me, continuity with these high grade deposits matters as much or more so than grade. Because if you're going to get bought out, like, is it going to stay 10 grams or 15 grams? Or is that just, a pipe dream? And so recently, I bought shares in an ASX listed company that's got 2.2 million ounces, over 10 grams. But the CV of their mineralization, the gold mineralization, is 1. That's what I want. There's an underlying bid there for that company, okay? Because somebody who buys that knows what they're going to get. So continuity is very important for people to understand when they're trying to say, oh, look at that intersection, it's great. Well, what's it actually going to look like when I actually mine it? And I'm still, like Brent, not convinced that somebody is willing to take the big jump into Pretium, given, background is Pretium's done an excellent engineering job building that project, permitting it, putting it into construction, and operating. The problem has always been the underlying deposit.
Okay. I'm just going to I'll deal with a couple of quick macro questions that came in here, just quick. China's not pumping money like the US. Why? It's hard to tell how much money is being pumped by China. I mean, their central bank certainly isn't. China's been doing other things. They have been changing bank ratios. A lot of the money in China flows through the shadow banking system. They're really, and I think I think Beijing's expectation, correct or not, I'm not sure it's correct, is that they're going to come out of this relatively quickly. I suspect what you might see in China, maybe 3 months down the road, pick a date. I think there's a fairly high probability you'll see them do another depreciation. I mean, they've been holding off partially because there's been this fight going on between them and the US, trade wars, all that. I suspect China would dearly love to drop the yuan down to 8 or 9. That would solve a lot of problems for them, but it would create some massive political ones. I'm not sure they're going to take that on unless things look nasty enough they feel they have to. But I got a feeling that card's still up their sleeve. Somebody else asked why Chile hasn't declared mining an essential industry. I think it really comes down to what an individual government feels the risk is at a more general social level, if you will. Yeah, you can make the argument that mining is an essential industry in Chile. You can make the argument it's an essential industry anywhere. I think most people would argue, I would make the argument in the short term that the most essential industry is probably something like grocery stores, quite literally, and gas stations, quite literally.
Liquor stores.
Or liquor stores.
Manufacturers.
Yeah, I mean, that's all. I mean, you take your pick. These things can all be defined as essential industries if you want to. But I think some governments have simply pushed harder on the social distancing stuff, and they've closed them. I mean, I don't know why. Like in Canada, for instance, in Ontario, mining is an essential industry, and I don't know why that one's on the list. I mean, I don't think it's bad that it is. I'm just not sure why Ontario specifically decided to make it an essential industry, and a lot of other places didn't.
Yeah.
I believe it's. Do you know whether it's essential in the U.S. or not, Brent? I mean, I know it's kind of state by state, but
Yeah,
It's
state by
state by
state.
state.
I think Nevada, Utah, and Idaho
Yeah.
have all considered essential. I don't know about any other states.
And that's why Liberty can keep drilling.
Right.
You know, and somebody like Barrick with a lot of exposure in Nevada is still doing well. But also it depends on the company, because some companies, even though they could conceptually keep operating like they're operating, they have reduced operating activities because of the introduction of COVID-19 preventative issues. They have to sometimes triple shift people to get the same productivity. Because they have to distance people, and also they have to have 2 weeks where people stay in quarantine, going into site and going out of site. And so all of that impacts productivity and increases costs.
yeah, I mean, I think one thing you may see this summer, I suspect, over the last 20 or 30 years, it became a lot more common to see, you know, I would say a 2 or 3 week turnaround on exploration crews. I got a feeling what we might see this year is, because I've talked to a couple of CEOs that have been mulling this over, saying, look, you know, if we have to have enforced quarantine, and they said, look, we're fine with that. If we got to put the crew in a motel in Terrace or wherever for 2 weeks before they go in, we're probably going to be switching to, rather than a 2 or 3 week turnaround, it's going to be like a 6 or 8 week turnaround in camp.
Yeah.
That's just going to be the deal this year. If you're going into camp,
Yeah.
you're staying for a couple of months, because it
Yeah.
just adds so much cost if you've got to put people up someplace for 2 weeks every time they flip in and out of the camp. So
Yeah, especially when you have a short season like Alaska or northern BC, it makes sense to go back to what I used to do when I used to work in the Arctic. You'd go 2 months, and then it wasn't a COVID-19 thing. It was just that we're not coming back for you.
right, yeah.
Hey, guys, since we switched this from Wednesday to Thursday, I've got a conference call I can't get out of right now. So I'm going to have to log off, and wish you all good luck out there, and hope everything comes out better at the end of this. Thank you.
Okay, I'm gonna Joe and I can just sort of grab 2 or 3 other questions maybe, and then we'll probably wrap it up. Do you have any comments on, somebody asked about PGM, and I assume they're talking about the company. I suppose you could read that as being the Platinum Group Metals as well.
Yeah.
But I think they're asking about the company PGM.
Which is the company PGM?
That's Platinum Group. That's got the
Oh, I thought that they're PTM.
I have no idea.
Okay, well, I do.
I don't
Yeah,
follow it.
so Platinum Group Metals as a commodity, palladium has done well. That was more of our focus because of the catalytic converters on internal combustion engines, more so than platinum. And the exposure that I took was on Platinum Group Metals, which I think is PTM on the Toronto, and PLG in New York, which actually it trades more on. So it's similar to Trilogy Metals with respect to, you know, that they've got the copper project. They did the joint venture agreement with Cell 32. Now they're funded for a few years that they don't have to do anything, which is very positive for them. That's what I was hoping for with Platinum Group Metals on their Waterberg project, the underground project in South Africa on the northern limb of the Bushveld complex. So right now, because of the COVID-19 in South Africa, the permit that we were hoping would be in hand by now has been delayed, and so we might not see that for another, I don't know, 3 to 4 weeks. And then after that, we have a 90-day time frame where Impala have to trigger their option, which is increasing their joint venture ownership into 50% and actually taking over the operatorship. So those are the 2 big catalysts that we're waiting for. In the interim, the company Impala has funded a program right now such that a lot of the critical path items don't get delayed. And that's really around the underground declines and making sure they get the earthworks advanced on those, as opposed to Centerra with Premier that are delaying the development of the project. Impala continues to fund that part of the development. And if they
Okay.
don't continue with the joint venture, they lose that money.
Okay, and I just had a whole bunch of questions right on top of each other come in where I think people saw the reference and then they asked, well, what about PGM Pure Gold mining? I don't know. Do you follow it? I follow it a bit. I mean, do you follow it as well?
No, I don't follow it, but I know it's a Madsen project, underground development in Ontario, but I don't really, I haven't kept up with it.
Okay, yeah, no, I'm okay with it. I mean, I think it'll be fine. They've got good management. I didn't love the amount of dilution they undertook to finance it. It's one of those deals I wish they would have waited 3 months, because I think they would have got a far better deal in terms of equity dilution at least. But done is done. They've got the money to get going. They've got some holdups because of COVID, like everybody else. But they seem to think they'll still be on track in terms of getting it up and running and production started. Obviously, gold prices do what I'm hoping they're going to do. They'll have a fairly significant impact on their cash flow. And I think the intent of those guys, I mean, I think if somebody had come to them and made what they consider a good offer, and I'm really not sure, I've never been able to get an answer out of management in terms of what the magic number would be in terms of a buyout. My sense now is, having gone through the pain that's always involved in building a mine, I think probably what we'll see them do, especially if we see cash flow come in the way they're hoping with these higher gold prices, is they may end up being a buyer rather than a seller. I suspect that they're probably looking for things to add to it. I mean, they recognize that single mine always gets you a discount. So I wouldn't be surprised if they're actually out shopping right now. I don't know who the obvious buyout for them would be. They have a lot of stock out, but they're getting to the point and should at the point when they're in production, they've got enough market cap. They could certainly be going after some of the smaller stuff. But I think it'll do fine. I mean, I would have been happier if they'd financed in a way that there was less equity dilution.
Yeah.
It would be more of a mover that way. There's just a hell of a lot of stock out, so it takes a huge amount of volume to move that stock. I'm just gonna make a couple of quick comments on Excelsior and on copper, because there were several questions about that, and I know you guys don't follow it. Excelsior is a copper project in southern Arizona. It's an in situ leach project. I'm reasonably comfortable that it's going to work. They did have some issues when they started up, and this was something a lot of people did talk about. I don't think they were major issues, but I think they had some issues with a couple of minerals that were building up in the system. So they did something they were planning to do in a year or two anyway, which was to change the plumbing a bit so that they could essentially flush the system. They've finished doing that now, but with COVID, it sounds like they decided to just keep the guys off site for 2 or 3 weeks. I have no particular reason I think it's not going to work. I'd like to see them get it going again, because if it works according to spec, their operating cost is actually going to be fairly low in the spectrum. It should be one of the lowest cost operating cost copper operations. In terms of longer term for copper, short term, obviously, like any other metal, any other thing, you've got this huge demand shock you're going to have in the short term. I expect that's going to be an issue for copper for at least several months. The one saving grace we've had, I guess, on the copper side so far, at least, is there's been enough shutdowns that while we've seen warehouse stocks go up, they haven't gone up as much as they would have if we hadn't seen multiple shutdowns. The other thing that, I don't know if you call it good news, but I think it will be for the longer term copper price. I think this price being shifted back down to the low twos. A lot of large, high capital intensity projects that were on the drawing board are probably off the drawing board now.
Well, Quebrada Blanca
production curve is shifted down.
Quebrada Blanca has stopped development, the big one in Chile, to your point.
Yeah, so if we get the sort of growth in copper demand we expect, once we get past this, we got to get past this. I would think the medium long-term prospects for copper prices are probably a little better, right, Joe? Because some of what people thought might be coming on in 2 or 3 years just won't be now.
Well, see, the other thing is with that, it spring loads the 2023, 2025 much more, considering that some of the projects people are talking about that are committed are not coming on as fast. But I mean, if you look at the forecast, you need a significant proportion of uncommitted capital to come in to just get, you know, the market balanced by 2025, which now they're not even committing to the committed stuff. So that sets up a more of a spring for 2023, 2025. And there's not a lot of projects in the pipeline. And that's, for me, that's why I'm in things like Trilogy. And the other thing that COVID-19 has sort of engendered with the market is supply chains. Not only supply chains with getting, you know, goods and services into a mine, but also production lines, such that, you know, people want their copper closer, or their lithium closer, or their gold, whatever, closer. And so there might be an issue with respect to getting more premium for something that's more local in the future.
Yeah, I suspect that's going to be, I think that's going to be an economy-wide thing coming out of this. It's going to factor more, obviously, in industries that are considered strategic, which you certainly could consider base metals. It kind of feels like this COVID crisis is going to be the end of the whole offshoring trend that went on for 30 years. I think globalization is going to get reversed a little bit. I'm not sure how I feel about that, but I think it's going to happen. It's just politically way more difficult right now. There's a lot of backlash. I got one question. I think we'll make it the last question because we're already in a pretty long time. It's a company I looked at a little bit, but I have to revisit. I haven't really sat down with them for a while, but I think you have, and that's Radius. If you got any feelings about, I'm not sure where you are with Radius in the newsletter these days. Radius Gold.
Yeah, so we own a Radius, and I like it. I mean, you know, working capital wise, it looked better a few months ago because they own quite a few shares of other companies, and a lot of those shares have come down, so their working capital is lower than it was. But this company has done a great job in managing its own working capital, such that they haven't raised money, and I don't even remember the last time they raised money. And they've still generating projects. And so the Amalia joint venture with Pan American, even though the COVID-19, they've stopped the last phase of drilling, Pan American is now the operator, and they've found a new zone to the southeast, which looks interesting. I think it's called Cuervo. So that will keep going once COVID-19 you know, constraints come off. But also they found this new area called Plata Verde, which they're just getting into. Granted, right now they can't, but they're continually generating new projects. You know, the permitting for the Nevada centers that they have in Southwest Nevada, close to the California border, has taken longer to permit. But in the interim, you know, I'm, you know, because I also own Bluestone Minerals, the development gold project in Guatemala, I'm more bullish about Guatemala than I was previously, and hence also our exposure in Pan American. Radius has been in Guatemala for the longest, and so they've got a lot of ground there. So if Guatemala picks up and people need feed, they have a lot of interesting projects in Guatemala. And so, yeah, I continue to hold Radius because they can keep their G&A tight. They continually looking for new projects and new discoveries, and you know, they'll just keep rolling.
Okay, I think that's it. I mean, we've run on pretty long here. I just want to thank you guys again. Thanks a lot, Joe, for fixing your internet and and coming on today. And thanks, Brent, wherever you are. And of course, thank you in the audience. This will be generated into a recording, and we'll get a link out to you probably in the next 24 hours or so that will allow you to listen to this as a replay. And we'll do this again pretty soon. Okay. Thanks, Joe. Thanks, audience. Thanks, Brent. I'll see you all later.
Great. Thank you, Eric.
Ta-ta.
Cheers.
Yep.